Hello, everybody. Welcome to Thursday. The S&P 500 was down 2.5% today. Really was kicked off at the beginning of the day with a retail sales report that came in worse than expected. So for November, we were expecting a 0.3% drop in retail sales, and we ended up with 0.6% drop. And of course, this feeds the fears of a recession that might be coming. In terms of, the consumer might be able to bail us out of a steep recession by continuing to spend. And this number obviously is going the opposite direction as that, as well as what we heard yesterday, kind of this very hawkish, comments from the Federal Reserve that were coming out. The combination of those two things where the market would look at it and say, hey, things are slowing down. We can see that in consumer spending. And the Federal Reserve is talking about raising rates even more, which could cause even more problems. And so kind of digging below the surface here, you can see a couple different things. Number one, this particular retail sales report that just came out is very heavily weighted towards goods. Again, things we can order and refrigerators and cars and things we can order on Amazon and such, and very lightly weighted towards services. If you look inside the report, services were actually up 1% for the portion that they had in there, which is money spent on restaurants and bars. I think really to see what's happening with the consumer, I need to wait till next Friday when we see the other personal expenditures reports that are going to come out that are, I think, a better representation of services versus goods. And so this is not a news to anybody who's been watching this. And matter of fact, we talked about this in our summary on Friday that, the goods are coming down and services are going up. And people are able to get out and do things and go spend money at restaurants and bars and hotels and airlines and, all those types of things. And so that's happening at a higher rate. And they're deciding to spend their money there instead of what we were all doing during 2020, which is spending on, things that we could at that time. So that's not too surprising. The other thing I think is really important here, again, I mentioned this yesterday, the Federal Reserve has been very wrong in their projections as to where they're going to be. Just last September, they said they wouldn't be raising rates at all in 2022. We've had nearly a record amount of rates increased in 2022, as it turns out. And so if you look at what they talked about yesterday, they're going to have a higher peak rate, and the market disagrees. Actually, if you look at the two-year Treasury, it really hasn't moved much since the Fed meeting yesterday, a little bit, but it's quite a bit off of its highs. If you look at the futures market for where the futures market thinks the Fed rate is going to be, it really didn't move. It's quite a bit below where it was at its highest point and lower than what the Fed is projecting. So again, we've got two scenarios here. We've got a retail sales report that came out that shows that goods are falling. So that's nothing new. Theoretically could actually help some of the inflationary environment that we're in. And then you've got the Federal Reserve, banging the drums, trying to bring the market down. And really, if you look at the bond market, it's not buying it. So I pay more attention to the bond market. I've been saying this for a while now. The bond market has been much more accurate and the futures market at figuring out where the Federal Reserve is going to go. So we did, kind of bounce off of some support levels right at around 3,900 on the S&P 500, a little bit below that for the close. So we'll see how this plays out. And, you never know when things might just kind of cascade to the downside. So we're ready to make more defensive moves if needed. But this is a little bit of an overreaction so far today. We'll see what happens tomorrow. So look forward to talking to you then. Thank you very much.